this question is extremely important when it comes to your understanding of the fundamental principles in costing for management accounting. We are going to work through the entire flow of transactions, starting with when the company first buys the raw material to when they issue it into production. They incur conversion costs. Remember, your conversion costs are your labor and your overhead costs to convert your raw material into your finished product, and then when they finally sell the finished product. And you are going to have to prepare the journal entries, the general ledger accounts, and also the statement of comprehensive income. So you'll see the entire flow of transactions right through the process from the start right to the end. Although it's unlikely that you will get a question like this at a CTA level, it's very important that you understand the fundamental principles covered in this question before we move on to the more complex areas of the syllabus. So let's start by working through the information provided. The following information relates to Darwin Enterprises for the month of January 20X8. So first, we've been given information relating to their finished goods inventory. We've got their opening balance at the 1st of January 20X8 and their closing balance at the 31st of January 20X8. And you've been given the rand values of your finished goods inventory for both absorption costing and for variable costing. Now, obviously, because these are rand values, the amounts are going to differ depending on whether we use absorption costing or variable costing. Because you guys know, with absorption costing, we are going to include both our variable and our fixed production costs in the cost of inventory. On the other hand, with variable costing, we only include our variable production costs in the cost of inventory. So it should make sense that both of these values over here are higher for absorption costing and lower for variable costing. Higher for absorption costing because it also includes your fixed production costs. We are then told at the 1st of January 20X8, there was 10,500 Rand direct material in inventory. So in addition to our finished goods inventory, we also have direct material. During the month, Darwin Enterprises purchased direct materials for 90,000 Rand and 97,000 Rand was issued into production. All right, so that paragraph gives us all of the information relating to our direct material inventory. Total direct labor wages amounted to 140,000 Rand and admin salaries amounted to 52,000 Rand. Actual fixed manufacturing overheads for the month of January totaled 313,200 and 3,490 units were produced. Their budgeted fixed manufacturing overhead for 20X8 is 3.6 million Rand and their normal capacity is 36,000 units per annum. During the month of January, sales amounted to 650,000 Rand, and you can assume that Darwin Enterprises does not hold stock of any incomplete inventory at month end. All right, so what is the significance of this? We know that inventory is made up of 3 different categories. Inventory is made up of raw material, work in process, and finished goods. Now in this question, we know we have raw material, we have direct material information above, and we also have information relating to their finished goods inventory. But in this paragraph, we are specifically told that they do not hold stock of any incomplete inventory. In other words, they do not have any work in process. In Part A of the required, we need to prepare the journal entries, the general ledger accounts, and also the statement of comprehensive income, first using variable costing and then using absorption costing. All right, so for now, let's just focus on variable costing. Remember, with variable costing, we only include our variable production costs in the cost of inventory. All of our fixed costs are going to be expensed in the period incurred. So if we start with the journal entries and the general ledger accounts, first let's just take all of the opening and closing balances that we've been given in the question and include all of the opening and closing balances in our general ledger accounts. After we've done that, we can look at processing the new transactions for the month. So first we are looking at variable costing. So for finished goods inventory, we have an opening balance of 4,500 Rand and a closing balance of 13,200 Rand. So these are my general ledger accounts for variable costing. Here's my finished goods. Remember, this is going to be an asset. This is a category of inventory. We have an opening balance of 4,500 Rand, and we have a closing balance of 13,200 Rand. Then for direct material inventory, we have an opening balance at the beginning of January 20X8 of 10,500 Rand. So here's my raw material inventory. So also inventory, so this is an asset, and we have an opening balance of 10,500 Rand. All right, so those were all of the balances. We can now look at processing our journal entries for the transactions that occurred during January 20X8. And at the same time, while I'm processing the journal entries, I will also record them in these general ledger accounts. So we are told that during the month they purchased direct material for 90,000 Rand and 97,000 Rand was issued into production. So let's first look at these two transactions. First, what is your journal entry when you buy raw material? We are going to debit our raw material inventory. And we are going to credit either accounts payable or bank, depending on whether this purchase was paid for with cash or on account. All right, so they purchased raw material inventory to the value of 90,000 Rand. All right, guys, I'm not going to include the journal entry narrations over here, but please note if you are asked to prepare journal entries in either your test or your exam, you must include journal narrations unless you are specifically told not to include journal narrations. So if you go to the suggested solution that I've provided you with, all of the journal narrations are there. So the narration for this journal entry would obviously just be, this is recording the purchase of the raw material inventory for January 20X8. Then in addition to purchasing raw material, they also issued that raw material into production. So we need to take it out of raw material inventory. We credit our raw material inventory. And when we issue raw material inventory into production, we take it to work in process. And that was 97,000 Rand. All right, so your journal narration over there would be, this is the issue of raw material inventory into production. So let's record these two journal entries in our general ledger accounts. First, we said when they purchased raw material inventory, we debit raw material inventory, we credit accounts payable or bank. And that was for 90,000 Rand. Then when we issue the raw material into production, we take it out of our raw material inventory and we take it to work in process. So here's my work in process account. This is also a category of inventory, so this is also an asset. We debited work in process, we credited our raw material inventory. 97,000 rand. We are then told that total direct labor wages amounted to 140,000 rand and admin salaries amounted to 52,000 rand. So let's record these two journal entries. So to record the direct labor cost, we are going to debit our wages control account. And we are going to credit bank with 140,000 rand. I will explain that in more detail now. And for the admin salaries, we are going to debit our admin salary expense. And also credit bank. So let's record these in our general ledger accounts. So I said to you, to record the direct labor cost, we are going to debit our wages control account and we are going to credit bank with 140,000 rand. And for admin salaries, we are going to debit our admin salary expense. So this is an expense account, and we are going to credit bank with 52,000 rand. So for admin salaries, please note that this is an expense because it is a period cost. Admin salaries has got nothing to do with manufacturing or the production process. It's a non-manufacturing cost or a period cost. It does not get included in inventory valuation. It is expensed in the period incurred. On the other hand, direct labor is a production or a manufacturing related cost. And please note also, in this part of the required, we are specifically looking at variable costing. And with variable costing, we know that we can only include variable production costs in the cost of inventory. All of our fixed production costs will be expensed in the period incurred. So whenever we have any variable production costs, that must be allocated to the cost of inventory. And please remember from our lecture, direct labor is going to be classified as a variable cost because it is direct. Remember, if it's a direct cost, that means it can be traced to a specific product. So this is going to be a variable cost. And because we are dealing with variable costing, all of our variable production costs must be included in the cost of inventory. So please note, I said to you, this is a control account. And if it's a control account, this means it must balance to zero. So we need to take this out of my wages control account. I need to credit my wages control account with 140,000 rand so that this balances to zero. And I'm going to take this to work in process because I'm allowed to include the cost of my direct labor in the value of inventory. So we are going to debit work in process. We credit our wages control account. With 140,000 rand. So because this is variable costing, both of my variable production costs are included in the value of my inventory. So raw material is a variable production cost. Direct labor is also a variable production cost. So both of them are included in the cost of inventory. And this wages control account now balances to zero. So there's no expense over here. With admin salaries, we are sitting with an expense of 52,000, but with my direct labor cost, I don't have an expense. I've cancelled this account out. It now balances to zero, and I've included that cost in the cost of my inventory. I've taken it to work in process. So let's just prepare that journal entry. Then next we were given information relating to our fixed manufacturing overheads. So please note, because we are still looking at variable costing, our fixed manufacturing overheads are not going to be included in the value of inventory. They're going to be expensed in the period incurred. So for the month of January, we have an actual fixed manufacturing overhead cost of $313,200. So let's record that transaction. You're going to debit your fixed overhead expense. And you're going to credit either accounts payable or bank. Record that in our general ledger account. Here's my fixed overhead expense. So this is variable costing. This is going to be an expense or a period cost. We debit the fixed overhead expense. We credit accounts payable or bank to record that transaction. All right, we were then given the sales for the month. We'll record that just now. Let's focus first on all of the costing journals, then we'll record the sale for the month. We were told that they do not hold any stock of incomplete inventory at month end. So there must not be any balance in work in process at the end of the month. So this helps us with our next journal entry. We need to clear out this work in process account because we are specifically told that they don't hold any inventory of incomplete goods. So obviously, when work in process is complete, it's going to be transferred out of work in process to finished goods. So let's look at that journal entry now, where we are going to debit our finished goods and credit work in process. And you just need to make sure that your work in process account balances to zero. So this is going to be your balancing figure over here, which is 237,000. So work in process now balances to zero, and we take that to finished goods. So let's look at that journal entry. Right, then just go back to your general ledger accounts and let's make sure everything here has been closed off. So for our raw materials inventory, we're going to have a closing balance over here at the end of the month. So calculate what that closing balance is so that this account balances. We'll have a closing balance of 3,500 Rand at the end of the month. Our wages control account balances to zero. For admin salaries, we are left with an expense of 52,000, which is correct. It's a period cost. It should be expensed in the period incurred. The same applies for your fixed overhead expense. We have an expense there of 313,200. Work in process balances to zero because everything was taken to finished goods. For finished goods, we know what our closing balance must be because this was given in the question. So my balancing figure over here must be what was actually sold. So remember, when we sell our inventory, we process 2 journal entries for the sale. First, we record the sale, where we debit either bank or accounts receivable. And we credit sales. So remember from the question, sales for the month of January was 650,000 Rand. And at the same time, we also debit cost of sales and we credit our finished goods inventory because remember what we are doing over here, this is your matching principle in financial accounting. Initially, all of these costs are treated as an asset and included in inventory valuation. When we finally sell the inventory, we then expense the cost, so we take it to cost of sales, we expense the cost in the same period that we recognize the sale. So that's what we are doing over here. When you recognize the sale, you also take the cost to cost of sales. So if you go to the general ledger accounts, this is going to be our balancing figure over here, where we are going to debit cost of sales. Remember, cost of sales is going to be an expense, and we are going to credit finished goods. And this is the balancing figure over here to make sure that we have a closing balance of 13,200 Rand for our finished goods inventory. So you force this account to balance. So my balancing figure over there is going to be 228,300. Okay, so that deals with the journal entries and the general ledger account. We now also need to look at our statement of comprehensive income. And we are looking at variable costing for now. I'm going to start by just writing out the skeleton of my statement, and then we can input all of the numbers. So we always start with sales. We then deduct cost of sales. And we calculate the value of cost of sales by taking our opening inventory We then include all of our variable production costs because we are looking at variable costing right now. So we had two variable production costs. We had material and we had labor. So we take our opening inventory, we add our raw material costs, our labor costs, and we deduct closing inventory. To get the value of cost of sales. Then if we have any other variable costs, those should be deducted now. So for example, if we have sales commission or anything like that, you should take it out. We didn't have any other variable costs in this question. So sales less cost of sales is going to give me contribution. And I can call this contribution because I'm only deducting my variable costs under cost of sales. So make sure you are using the correct terminology. Contribution is sales minus all of your variable costs. We will then deduct all of our fixed costs. So we had a fixed manufacturing overhead. And we had admin salaries. and that will then give us our net income. For January 20X8, we had sales of 650,000 Rand. For opening inventory, please be careful, we had both raw material and finished goods inventory. So there's my raw material inventory, and here's my finished goods inventory. And then for both of them, we also have closing balances that we need to take into account. So my opening balance for my raw material inventory was 10,500, and for finished goods inventory was 4,500. My closing inventory for raw materials was 3,500, and for finished goods, 13,200. So you can calculate the value of your opening and your closing inventory. So please note, in this question, we didn't have any work in process. If we did have work in process, you would also include those values in your opening and closing inventory. Then for raw material, please note this must be the raw material that you actually purchased during the period. So we purchased raw material to the value of 90,000 Rand. So I just want to discuss this in a bit more detail so that you can see what I'm doing. For my raw material, we have opening inventory of 10,500, purchases of 90,000, and closing inventory of 3,500. So if you look at this calculation, opening inventory plus my purchases of 90,000 minus my closing inventory of 3,500 is going to give me what? This leaves me with 97,000 Rand. So what is that? Go back to your general ledger accounts. That is the actual expense for the month. That is what they actually used in production. 97,000 Rand worth of raw material was issued into production. So on my statement of comprehensive income, I'm expensing the actual cost for the month of 97,000. But the way we expense that cost is we start with our opening inventory of raw material, we add our purchases, we deduct our closing inventory, and the net effect is I expense the amount that was actually issued into production during the period. Or in other words, if you look at your work in process account, it's the same cost that we took to work in process. And the same applies for direct labor. Remember, direct labor is a product cost. It gets included in inventory valuation. So we took it to work in process, and we have a value of 140,000 Rand. You can then calculate the value of cost of sales. And you will see that also ties in perfectly with our general ledger accounts. There's my cost of sales amount over there. Then we had two other costs. We had admin salaries and the fixed overhead expense. So let's just complete the statement and calculate our net income. All right, so that's everything that we needed to do for variable costing. Our journal entries, our general ledger accounts, and also our statement of comprehensive income.